Well, good afternoon, and welcome to the FlockBase webinar for the COVID-19 tax update for churches. My name is Kevin Cheshire, and I will be with you for about the first half of our time together. And then my business partner, Jerry Walker, will be here for the second part. Just in case, if you are unaware, we had two previous webinars today. Did one this morning and then one around the middle of the day. The first one was basically a tax update for church treasurers, very appropriate for ministers as well. Just basic blocking and tackling of being a church treasurer, some basic tax principles. And that webinar is available on our Facebook. So if you go to FlockBase's Facebook page, you'll find that webinar. It's already up there. And then in the middle of the day, we did another webinar that was about an hour and a half long. And it was a setup of FlockBase from start to finish, from the very beginning. Ryan did that, and that video is already up as well. So both of those, you can find them on our Facebook account, or you can find them on our YouTube channel. So if you will go to youtube.com and find the FlockBase channel, you can subscribe to that, and there you will find those videos as well as several others that we think you will find helpful. There are copies of a video about how to do 2020's version of the W4 and several other things, several other videos that will help you as a user of FlockBase. Now, today's video, or this webinar, is not specific to FlockBase in any way. It's just sponsored by FlockBase. So let's get moving. And first of all, this is information that is new to everybody. Before March the 18th of last year, none of this existed. And there are still a bunch of unanswered questions out there. But we'll do the best we can with giving you a general overview of the topic. And as with all of our webinars, we strongly encourage you for your specific situation to seek appropriate professional guidance, whether that be from a lawyer, CPA, whatever. You need to get help that fits your specific situation. Our goal is to do an overview and make you aware of potential issues, and some of those things you might benefit from. So it might just cause you to start asking questions and might benefit you. Well, let me introduce Jerry first. Jerry has become one of my best friends over the last few years. God put us together, about 6 or 7 years ago, first time we met. And since then, we've become business partners in 3 different ventures, FlockBase being one of them. And Jerry was one of the 2 gentlemen who founded FlockBase back in the 2005, 2006 range. So it's been around a while, and I've only been a part of it for the last 3 or 4 years. But Jerry's just a wonderful guy. Been in public accounting for 28 years. I think it's actually 29 years now. He and I are partners in the accounting firm that he started almost 25 years ago. And he has done a ton of church accounting and tax consulting. Matter of fact, when he first opened the CPA practice, his very first client wasn't a church, but it was a religious organization and a mission organization. So he's got strong roots and been involved for a long time. And he has also prepared many, many ministers' tax returns. And he's just a wonderful guy. I'm Kevin Cheshire. I'm a partner with Jerry and FlockBase. And I've got about 30 years of experience in accounting, maybe a little more than that. Been on a church staff for about 23 years, on the staff at 2 different churches, serving in a business administrator or administrative type role, and just really thoroughly enjoyed those years of being in vocational ministry. And I've done significant counseling and consulting with other churches and ministers, and done tax returns for minister for years. So Jerry and I have a parallel history, just from a little different perspective. Most of his experience is from being a tax professional and working as a professional in that relationship with churches and ministers. And a whole lot of mine, probably most of mine, has been from the other perspective. It's been from being on the inside, being on a church staff, which I don't know that either one of those is better or worse or good or bad. They're just different perspectives. So we see things at least a little differently, although he and I really agree on just about everything. And we do agree on everything we're going to talk about today. Both Jerry and I, just so you know a little bit about us, and I'll get into the material here pretty quickly. I just want you to know a little bit more about us. We're both small town Texas boys. We grew up in small towns. married, have kids. Kids are mostly grown now, about the same cycle of life, although Jerry's a few years younger than me. But I just count it a privilege to get to be a part of doing business with Jerry and getting to be a part of his life. So let's get into the material here. Here's the schedule. Like I mentioned, we had a webinar at 9 and another one at 11:30, and then we have this one now, COVID-19 laws for churches. The first two are already loaded if you want to go look at those. This webinar is going to cover these items. We're going to just basically do an introduction of FFCRA, the CARES Act, as well as CCA 2021. And those are collectively the COVID legislation that Congress has passed over the past 10 months to provide relief due to the coronavirus epidemic and pandemic. We're going to talk about mandatory sick family leave, pay for employees. And the most important word in that sentence is mandatory. That happened back in 2020. It's a little different for 2021, but we'll go through the basics. We're going to talk about payroll protection program loans, which turn into grants, or another way to say that is they're loans that can be forgiven. So how churches can apply for forgivable loans to cover payroll and other operating costs. And we had a first round of Pppl back in 2020, and there's another round that has just kicked off. So we'll provide you some helpful information for that. And we're also going to talk about refundable employee payroll retention credit, the ERC, employee retention credit. It's how churches can receive a tax credit for retaining employees during COVID, and there are special circumstances that must be in place for that to be applicable. We're going to go through the basics. Then we are going to talk a little bit about the potential of deferring payments of a portion of payroll taxes. Now, Jerry and I are both small town boys, very conservative. I'll tell you right now, we're not in favor of that, but it might fit in some circumstances, and we're going to at least tell you about it. And then there's a new rule for charitable giving, an above-the-line deduction. So we'll talk about that a little bit as well. And then we're going to do a Q&A session at the end. And we believe, this webinar is listed as 2 hours. We believe that we're going to be done in less than that. So we should have significant time at the end for questions and answers if you have them. So please feel free to fire those out. And since we feel like we're going to have time at the end, we probably will answer them at the end after the webinar is basically concluded. So if we don't respond to you quickly, just know that we're going to get to you. And it's possible that you may have a question that is specific to your circumstances or the complexities beyond really this webinar. And if that's the case, we may just take it offline and see if we can't help you specifically. We want to maintain confidentiality at all times. Okay, so that is the basic agenda. Some housekeeping. It's very important. This material has been prepared, and I mentioned this earlier, for informational purposes only. It's not intended to provide and should not be relied upon for tax, legal, or accounting advice. As I mentioned earlier, you should really consult your own tax, legal, or accounting advisors before engaging in any transaction, because the details of your situation may differ from the generic details we're going to cover. Post your questions via Facebook Live, and we're going to answer as many of those as we possibly can. And the third bullet point, third bullet point, try to save your questions. We're going to cover all of the material that's been on that agenda, so please hold on to your questions till we get beyond your topic. And if we haven't answered it, then please feel free to reach out. And then lastly, we are available for tax consulting and tax preparation, but not for free. We do tax consulting, and we prepare tax returns. That's what we do for a living. We also have FlockBase software that we work with. So we have a couple things going on, and we're happy to provide as much as we can, general information for free. But once we get to your specific situation, we will have to begin to bill you. So, and we won't sneak up on you on that. Just know that it's not always going to be free. Okay, let's dive right in. The FFCRA, Families First Coronavirus Response Act. This was the first legislation that came out of Congress after the pandemic hit. And I got to be honest with you, when this came out on March the 18th, I was thinking, oh, this is not going to last long. We'll be fine by summertime. And the way that it was impacting me at the moment was the spring softball league I play in was derailed. It was postponed. And when they first postponed it, we were thinking it was going to be a week or two. Or I was. And I believe they were thinking that. Well, that eventually got canceled. And a lot of things got disrupted. But this is way back at the beginning. March 18th, this was the first one. And a lot has changed since then. A tremendous amount has changed. We've had many people that have lost their lives to COVID. Many people have been ill for periods of time and have permanent consequences. And it's just been a much worse event than I ever thought possible. And hopefully it's not been bad for you. And hopefully if it has, you're beginning to recover. I know a lot of people have been hurt economically. And I hope and pray that we're getting near the end and can start to get back to some normalcy in our lives. So it was enacted on March the 18th. I guess that was right at the end of spring break. Now it requires, it doesn't suggest, it doesn't recommend, it requires certain employers to provide paid sick or family leave for certain coronavirus-related events. And that's required, not optional. There are some exceptions, but we'll go through those. It also provides payroll tax credits to reimburse the employer for sick family leave paid to qualifying employees. So the bad news is bullet 2, you're required to provide it. The good news is bullet 3, you're going to get repaid up to certain limits via tax credits on your 941. Then came the Coronavirus Aid, Relief, and Economic Security Act, the CARES Act. You got to love those congressmen. They come up with some very unique acronyms. So the CARES Act, and it was enacted 9 days later, late March of 2020, to provide relief for both employers and individuals affected by the coronavirus pandemic directly as a result. Now, it provides assistance to employers to keep employees on the payroll. It also provides for payroll loans that can convert into grants, i.e. be forgivable loans. And then it also provides payroll tax cuts and deferment. And lastly, increased tax deductions for charitable contributions. So the first 2 acts were all that we had up until the end of December. So these provided the bulk of the relief that we have seen to date. And then in late December of 2020, Congress passed the Consolidated Appropriations Act of 2021. December 27th is the official date. Now, this act piggybacked on the other 2 by extending the expiration dates of many of the provisions in the FFCRA and the CARES Act, and then it expanded some of the benefits contained in the 2 prior laws. So if we had had this webinar back before this act passed, we were beyond the timeframes that had been given for a lot of the coronavirus relief, but those have been extended now. So let's talk a little bit about the paid sick or family leave. These are federal payroll tax credits. Now that's how it works. The employer pays the employee, and then when the employer files the Form 941 at the end of the quarter, you claim the credit. And what we've seen many of our clients get is they get a refund check from their filing of 941. And the IRS also came out with a form, the Form 7200, which you can file. It's like an advance 941. You can file that and get credits in advance. And that's in situations where the employer wants to retain employees but doesn't have sufficient cash flow to make that happen. So you can apply for using the Form 7200 and get your tax credit in advance, pay your employees, and then the credits get claimed later on the 941, and it should all wash out, or you'll settle up on the 941. So that's how this works. The tax credits reimburse the amount of qualifying leave paid to qualifying employees. So we've got a couple of things in there that are qualifying leave, qualifying employees, and we're gonna talk in general about that. And like I mentioned, the tax credits are claimed from your quarterly payroll tax filing or the special Form 7200. The tax credits include wages, payroll taxes, and health insurance for qualifying sick or family leave payments. Now, we just learned very recently in the last couple of weeks, maybe 3 weeks, that the payments are going to be reported in Box 14 of Form W-2, which is Box 14, if you're unaware, That's the box on the W-2 that is basically additional information that an employer chooses to provide to employees, not required by the IRS. It's supplemental information. You can disclose the information there, or you can put it on a separate statement. And that's what we believe we're going to recommend, is that you just put it on a separate statement. So between April 1st and December 31st, these sick and family leave was mandatory for all employers with less than 500 employees, and that is the vast majority of employers in the United States. So very many employers were required to provide this. Now for the first quarter of 2021, it's been extended, but now it's not mandatory, it's optional. You do not have to provide the paid sick or family leave. So this really comes in two pieces. We're going to talk about the sick leave part first, and then we'll talk about the family leave part. So basically for sick leave, you can have up to 2 full weeks, 2 full-time weeks, 80 hours. That's how much qualifies. And it applies to all employees without any relationship to their tenure. You could hire them one day, they could get sick the next, and they qualify. So there's no waiting period, if you will. So what are the reasons? What reasons can an employee be gone for that require the employer to pay sick leave? Well, there are 3 situations. Number 1, the employee is subject to a federal, state, or local quarantine or isolation order. And this includes shelter in place or stay at home orders, or the employee is advised by a health care provider to quarantine. And it's important, if this is the condition, we're coaching people to be sure that you get your documentation. Get something to prove that you got diagnosed or that you were told to quarantine. And then the third one is that you're experiencing symptoms of COVID-19 and are seeking a medical diagnosis, preventive care, or treatment. Now, these are the 3. This is not part of it. This is all of it. This is not the complete verbiage, but these are the complete ideas. And notice, the qualifying reason does not include a quarantine which is not under a governmental order or advised by a healthcare provider. So what would that be? If my wife is diagnosed with COVID and I have no symptoms, but I've been at home, we've been together, living in the same home, she's been diagnosed by a doctor as having COVID, well, I may choose to self-quarantine. But you notice that's not one of these on the list. If I have no symptoms, but I just choose to follow CDC requirement or recommendations and self-quarantine, I'm not covered. So just notice it's very generous if you stay within the rules. And the limit is also pretty generous. The limit is $511 per day. So it's over $2,500 per week that you can claim. Now that's limited to the amount that the employee earns and how much they get paid. So that's the paid sick leave. Paid family leave is up to 480 hours, which is 12 weeks. Now one fine point, you can only have 12 weeks per employee. So if you use 2 as sick leave, that means you can only use 10 or 400 hours for family leave. Now, another key difference here, employees must have been employed for at least 30 days before you become eligible for family leave. So from date of hire, you have to have been an employee for 30 days before you can take the paid family leave. Qualifying reasons, these are basically for caring for others. It's not you that's sick, you're dealing with the situation for a family member. So you're caring for a family member under quarantine or under isolation, or you're caring for a son or daughter due to a school or child care provider closing. Now, I don't think there's much of that going on right now. You know, my wife works as a speech therapist in an elementary school, and they have had probably 10 classes that have been quarantined at one time or another, but the school has been open. So unless your child is in a classroom that has been quarantined, they've all been at school. And I don't know what the situation is in your area. Maybe it's far worse. I know that there are parts of the country that school closing and child care provider closings have been much worse than they are here in Texas. So here are some exceptions. This is required, except. Now you got three sentences here, three statements, and you have to have them all to get the exception. It has to be fewer than 50 employees. So a smaller company. And the policy would jeopardize the viability of the business as a going concern. And it may be that we don't have enough cash flow to do this. We can't do this. That's one of the reasons, but it's got to be all. Fewer than 50, jeopardize the going concern, and one of these three. Providing the leave would cost more than the church. We got church and the employer's available revenue. Or the loss of workers on leave would be a substantial risk to the church's finances or operations. Or there's not enough available and qualified workers to replace employees who are on leave. So if you can't replace the people and you meet these other criteria, you can choose to opt out. Now, we have kind of gone round and round of is this ever a good thing? You know, if you can continue to make it as a business, we believe that it's in your best interest to take advantage of the paid family leave and let your people be off. Now, this one is not as generous economically. Notice that it's limited to 2/3 of an employee's regular rate of pay, subject to a $200 limit. So if you have an employee who makes $300 per day, then we're limited to $200. So in that situation, you would pay that employee $300, and then you would get tax credits back for $200. It doesn't cover 100% of it. It only covers 2/3. But that would cover you for up to 12 weeks. So here are a couple of URLs where you can go to the Department of Labor and get additional information about sick leave and family leave under these acts. So I would encourage you to do that. If you think there's any possibility that your church might benefit, or if you're not a part of a church and you're watching the webinar, if it might benefit you as an employer or the employer for whom you work. So just seek out additional information if you believe it would be helpful to you. Okay, we are going to take just a very brief break, and Jerry is going to come in, and you're going to get to hear the better half of the show. So, Jerry, without further ado,
all right, thank you,
Jerry
Kevin.
Walker.
Yep. Glad to be with you folks this afternoon, and we're going to talk about some COVID law topics here. My first topic is the Payroll Protection Program loans. So I will refer to those as PPPLs. And here in our CPA office, that word is probably used 50 times a day. It's just lots of small businesses are using PPPLs, did last year, and maybe even using this second round of PPPLs, and churches as well. So we'll go through some pretty nitty-gritty details here and try to help you understand this. First thing I want to say and emphasize is there are 2 rounds of these PPPLs. The first round started last spring because of the CARES Act. That fired off sometime in March, and most of the PPPLs were not issued until April, May, some in June, a few in July, and maybe just a few stragglers out there in August. And then it closed, it ran out of money, and for a while there we thought that was the end, that was the end of the PPPL program. But then the act that was passed in late December included a second round of PPPLs. And there's some pretty nitty-gritty details that we need to understand about that, and I will cover those for you. But here's some kind of general overview that would apply to both of them, and that is these loans, these PPPL loans, are coming from the SBA, that's the Small Business Administration. And you might think that's a little strange that the Small Business Administration is making loans to churches, but that is that's the way it works. And these loans are up to 2.5 times average monthly payroll. So there's a formula we used, to calculate our average monthly payroll. Then you multiply that times 2.5, and that's the amount of money that you can borrow under both of the programs, the first and the second round. Another thing that's common among both rounds is that there are no fees and no collateral. So the federal government is picking up all of the fees associated with this. And there are some fees that are paid to the bank, and the bank gets a little bit of interest, and that's paid by the federal government as well. So, if you follow all the rules and spend the money just exactly like you're supposed to, you're not going to be out any money at all. You will pay no fees. You will pay no interest. It will be 100% free money as long as you dot all your I's, cross all your T's, and like I say, meet all the criteria. And there's quite a few criteria, so you do have to pay attention to what you're doing. All right, next we'll talk about that the balance of the loan is forgivable as long as you use the money for these categories. So these are permissible categories to use the money for. Payroll, and you need to use the bulk of the money on payroll because that's, in the title of the loan, it's the Payroll Protection Program. So the government says we're basically going to advance you a loan that we want to forgive. I mean, the government definitely wants to forgive these loans if you use them for the specified items, and the biggest item of all is payroll. But you can also use a small portion of the loan for interest on a mortgage. You can use some for paying rent, utilities, interest on other loans. Okay, so those bullet points cover the list in the first round of the PPPL. The second round expands the list to include a couple more items, and I think these probably make sense. It's expenses to comply with CDC guidelines. So if you're having to spend additional monies, to maybe do some protective screens or something, to protect the folks in your church, then those additional expenses do qualify as PPPL expenses. And then certain cloud computing costs, because if you're having to do, remote services, or your employees are having to work remotely and you've had to spend additional money on maybe some software or some services for cloud computing, that also qualifies as a PPPL expense. Now, there's a time frame in which you must spend the money in order for it to be forgivable. And originally, that was an 8-week time frame. So, back last spring when you could apply for your PPPL, and let's say you received $20,000, then you said, well, we have 8 weeks to spend that $20,000 on these eligible categories. But they came back later, I can't remember, 1-2 months later, and relaxed the rules and said, you know what, we're going to give you 24 weeks to spend the money. So, there's a little bit of pressure was being put on Washington, and so they relaxed the rules. And so under both programs now, first and second round, we can spend the money in up to 24 weeks. You kind of get your choice. Like, you can, if you spend all the money in 8 weeks, then that's fine, and you can go ahead and file your forgiveness application. But if you haven't spent it all in 8 weeks, then you can wait for the 24-week deadline and to see if you've spent all your money, and then file your forgiveness application. All right, continuing on with PPPLs. The term payroll, because one of your qualified list of expenses was payroll, it includes employee benefits. So that would include your health insurance that you pay for your employees. It would also include any matching of their retirement account contributions. So if your church offers a simple IRA plan like we discussed in the webinar earlier today, in a simple IRA plan, the church has to do some matching of the employee contributions, and so that is an employee benefit, and that is a qualified expense under the PPPL. Now, this is also very important news. We gave information about this topic, all the way back probably last April, in fact, and there were some unanswered questions at that time. So this is new information. Minister's housing allowance is an allowable expense under PPPL. There was a little question about that in the beginning. At one point, I didn't actually think it was going to qualify, but I now know, we've got confirmation that a minister's housing allowance is an eligible expense under the PPPL. Now, if you received a first round loan during 2020, you could apply for a second round loan between now and March 31st, 2021. But here's a new criteria, okay? So watch out for this. If you're trying to get a second loan, so you got a first loan, now you're trying to get a second loan, the new criteria, and that is that your gross receipts on a quarter-by-quarter basis are down more than 25%. So, that's, in just a second, I'll give you the criteria for the first round loan, but I'm now talking about, you've already got a first round loan, you want to apply for this second round. Jerry, what's my criteria? And it's this decrease in gross receipts by more than 25% on a quarter-by-quarter basis. Now, there's two different ways to look at your quarter-by-quarter basis. One way to look at it is comparing the current quarter, so first quarter of 2021, compare that to the fourth quarter of 2020, the most recently concluded quarter. So let's just throw out round numbers here, okay? Let's say your gross receipts, your gross contributions for the church in December 2020 were in the fourth quarter. I said December, but I need to say the quarter, so I apologize. In the fourth quarter of 2020, let's say your gross receipts were $30,000, $10,000 a month. But then for the first quarter of 2021, your gross receipts for that quarter were only $20,000. So if you compare the 20 for the first quarter of 2021 to the 30,000 of gross receipts for the fourth quarter, you can tell that we're down by a third. A third is larger than 25%, so we have a qualifying decrease there, and that means you're eligible for a first round loan. Okay? There's another way you can look at it, and that is comparing your first quarter to the first quarter of last year. So you can either look at the immediately previous quarter, or you can look at a quarter from a year ago and see if you're down by more than 25%. And if so, then you qualify for the second loan. Okay. If you did not receive a first round loan, okay, because many churches did not apply. I know some did, but most probably did not apply for a first round loan. And maybe now the church is maybe having financial difficulty because the pandemic has been hard on churches. And I know that kind of varies. Some churches, it's been hard on us, but financially I know some churches are down, some churches are flat, some churches are up. But if your church is down and maybe you're struggling and you didn't get that first round loan, you have a second chance to get that. And you will still use the criteria for the first round loan. So I know that's maybe a little confusing. If you got the first round loan, you have new criteria to get your second round loan. If you did not get your first round loan, you can get a first round loan right now using the original criteria. So let's look at those original criteria because they're important for all the churches that didn't get one last year. You can get one this year based upon last year's criteria. And so let's read through it very carefully. It's very important. Again, some churches will say, yes, I understand this and I agree and we meet these criteria and you can move forward. Some churches are going to say, no, I don't think in good faith, that we can meet these criteria. So let's read them out. At the end of the process, you have to sign a certification that says, an eligible recipient applying for a covered loan shall make a good faith certification that the uncertainty of current economic conditions makes necessary the loan request to support the ongoing operations of the eligible recipient. Okay? So you have to sign, on the dotted line, somebody for the church, whether that's the lead deacon, the head elder, the pastor, the finance director, the pastor of administration, whoever the responsible party is in your church that signs legal documents would have to sign on the dotted line and say, we need to make this loan request to support ongoing operations because of current economic conditions. And, some people would say, yeah, that's super easy. This is, these are crazy times. We're open one week, we're not open the next. Of course, we need this loan to because of the uncertainty of current economic conditions and for ongoing operations. Or I could see there's some churches out there saying, our finances are healthy. We're fine. And probably if you make that statement, then you probably can't sign on the dotted line saying you need the money. So, all right, number 2, and this is an and list, so you have to meet all of these criteria. Number 2, the funds will be used for payroll costs, paid sick, medical, or family leave, mortgage interest but not principal, interest on other debt obligations incurred before February 15, 2020, and rent and utilities. And I'm going to describe that. Those debt obligations incurred after February 15, 2020, you can't claim the interest on those. So, if you went out and got a new just loan at the bank, let's say after February 15, 2020, the interest on those new loans is not a qualified Pppl expense. But any loans that you had on the books before February 15, 2020, the interest on those loans is a qualified Pppl expense. All right. The final or the other criteria, number 3, the borrower was in operation on February 15, 2020. So, you couldn't have started your church after the pandemic started and then applied for the Pppl. And the borrower had employees for whom it paid salaries and payroll taxes or independent contractors as reported on Form 1099 miscellaneous as of February 15, 2020. So that just criteria just says you had to have employees by February 15, 2020, or else you can't apply for the PPPL. Now, included in that sentence is something that's terribly confusing, but this is an extract exactly from the law, so this is not a misprint. One of the criteria for getting the PPPL is that you either had to have employees or independent contractors. Okay, Congress wrote that into the law. That's one of these criteria. But payments to independent contractors are not eligible PPPL expenses. So why in the world did they make it a criteria when it is not an eligible expense? And notice it's in that number 4 there, it doesn't say you have to pay employees and independent contractors. It says you have to pay employees or independent contractors. So when you read the criteria, you'll say, well, we don't have any employees, but we have independent contractors, we qualify. Technically, you would qualify to get the loan. You just wouldn't qualify to get it forgiven if you're not paying employees and in your stead in paying independent contractors, because payment to independent contractors is not a qualifying expense. So what I think happened is when they were writing the law, at one point they thought they were going to include independent contractors as PPPL qualified expenses. They later removed them and forgot to go remove that as one of the qualifying criteria. So I truly believe that's an oversight, and the word independent contractor should probably not be in that criteria. But it is there, but it's virtually meaningless, because if you're not paying employees, then you're not eligible. Well, you're certainly not eligible to spend the money and get it forgiven. And if you tuned into our webinar earlier today, you will know that churches should not be treating their employees as contract labor anyway, even if it's the pastor. One of the big topics we cover in that earlier webinar was that the pastor and ministers of the church are employees, not contractors, even though they pay taxes like self-employed. So, a pastor of a church should get a W-2, not a 1099, even though I'm well aware of all the taxation of ministers. That minister is going to pay his own income tax and self-employment tax like he's self-employed, but he's still an employee of the church. So that was your criteria for the first round of PPLs. And remember, on the previous slide, I talked about the criteria for the second round of PPLs was the 25% decline in gross revenues. All right, just cleaning up a little bit of a detail here. Payroll is limited to $100,000 per employee. So if you have any church employees who make more than $100,000, and I suspect there's not very many, but there may be somewhere, of course. But if your employees make more than $100,000, when you're talking PPPL expenses, you don't get to include the excess over 100. So, if you have an employee that, let's say, makes $120,000 a year, as you're doing your PPPL calculations, you can't include the 120. You can only include 100, and the 20 of over and above the limit just kind of is not included in any of your calculations. Okay. To the extent loan proceeds are not used for the permissible expenses within the specified period, which is either 8 or 24 weeks, the unforgiven balance of the loan carries the following terms: 1% interest payable over 5 years, and the first payment is due 6 months after the loan origination. So honestly, we have not yet encountered any clients, whether they're small businesses or whether they are churches, that have not had their loans forgiven. But I'm sure somewhere in America there are, for a variety of reasons. On the news, I heard a few interesting stories about there was fraud. There were folks who went out and got these PPPL loans saying they had a business, and with a small amount of investigation, the government figured out there was no business there at all. So obviously there's those fraud cases where they're going to have to pay the money back and probably go to jail. But there may be other situations where a church or a business took the loan thinking that they were going to stay in operation, thinking that they were going to pay the payroll, and finally, but maybe they just gave up the ghost. They just said, no, we can't do it. We're just going to shut down and don't spend the money. So if you didn't spend the money on the qualified items, you've got to pay it back. You can pay it back immediately, and you won't have to pay the interest. Or if you wanted to pay it back out over the 5 years, you could. To get a PPPL, you need to apply through an approved SBA lender. And so if you're interested in this for your church, I encourage you to call your bank, your local bank, and see if they will do it for you. Some do, some don't. I mean, here Kevin mentioned we're small town guys, and we work in Weatherford, Texas, a town of about 40, 50,000 people. We've got a number of banks around, And on the first round of PPLs, I would say the majority of them did offered the PPPLs, but on this second round, I'm pretty sure it's a smaller list. So maybe some of those smaller banks didn't appreciate the process or whatever. So I don't think everybody's doing the second round. Every bank's doing the second round, but so you just have to check around. If your bank's not doing it, there probably another bank in town is doing it, or there's some internet banks and the big banks will do it. Of course, there's some difficulties sometimes dealing with internet banks or dealing with large banks. So I encourage you to probably start with your local bank and then kind of move out from there. And only churches with less than 500 employees are eligible. Probably not a problem for most of our audience. Continuing on with PPPLs. The average payroll lookback period can either be calendar year 2019 or calendar year 2020. So remember, when we first got started, when I was talking about PPPLs, I said the amount you can borrow is 2.5 times your monthly payroll. So, step one means I've got to calculate my average monthly payroll. And then you say, well, what period do I look at to calculate my average monthly payroll? And as of today, you get two choices. You can use all of the 2019 year or all of the 2020 year, whichever one comes out to your advantage. So if your 19 payroll was higher than 20, you would want to use 19. If your 20 payroll was higher, you would want to use 20. So you get to pick the 19 or 20, whichever calendar year you want to use as your look back period, and then you start doing your math. So I've walked through a little illustration here. Back in 2019, this employer had 3 employees. Their salaries, taxes, and benefits were $50,000, $75,000, and $125,000. So 3 employees, you see their salaries there. So what is my annual average payroll? Well, because I have 3 employees, 2 of them you can tell are below the $100,000 limit, and 1 is over the $100,000 limit. And remember, we're capped at 100. So the way that you would calculate your average is you would say, all right, we've got 1 at 50, 1 at 75, and then third one we can only include 100. So you add those numbers up. 50 plus 75 is 125, plus 100 is 225. Divide that by 3, and you're going to get an annual average payroll of $75,000. Okay? You divide that by 12, which would be $6,250 a month. Then you take that and multiply that $6,250 times 2.5, because 2.5 of your monthly payroll. And in this illustration, this church was eligible to apply for a PPPL of $15,625. So it's not a bajillion dollars, but it's nothing to sneeze at either. So this I think would be a significant benefit to the recipient. This $15,000. All right, let's talk about some reductions here. The amount of the loan forgiveness could be reduced if your average number of full-time equivalent employees during the 8 or 24-week period after the loan begins is less than your average number of full-time equivalent employees before. So the gist here is that to make you this loan, which will eventually turn into a forgiven grant, Congress said you don't need to be laying people off, because that's the opposite of what they want. They want you to keep your employees on board, and that's why it's called the Payroll Protection Program. So, you have to do an analysis to say, all right, before we got the loan, how many employees did we have, full-time equivalents, and then during our loan period, during our 8 or 24 week where we're spending the money, did we have the same number of full-time equivalents? If we drop down, then we could have to pay some of the money back. And it's a pretty complex formula, several pages. We normally spend a couple of hours trying to calculate that. But the bottom line is this: try not to lay anybody off while you've got the loan. So if you started with 8 employees, at the end of the 8 or the 24-week period, you need to try to have, the same number of employees, same number of full-time equivalents. And I use that phrase full-time equivalent employees because if you have, let's say, 2 employees who each work 20 hours a week, then that constitutes 1 full-time equivalent, because the 2 20s equal 40 and the 40 is full-time, and so there's your full-time equivalent. Okay. The second bullet point, the amount of loan forgiveness will also be reduced if the salary or wages of any employee is reduced by more than 25% when comparing the 8 or 24-week period after the loan begins to their wages during the most recent full quarter. So I think you get the gist there. Don't lower their pay because, again, we're trying to protect payroll. And so Congress said if you're maybe not laying people off, but you're cutting their pay, then we're going to cut into your forgiveness amount as well. So if you want full forgiveness during this time period that you've borrowed the money, don't lay people off and don't cut their pay. If you do both of those, you should be fine. All right. So that concluded the PPPL. And, I've talked to different churches, and some of them say, well, we just have a moral objection, to taking the government's money. And on some level, I can totally respect that and get that. And, I can definitely see where you're coming from. Now, I've also heard some churches say, well, yes, we don't want to take the government's money because we believe it will come with strings attached. And they're going to start telling us what we can teach from the pulpit and all of that sorts of stuff. Well, although I do believe those days are probably coming where the government's going to probably, get a lot more involved in our churches than we would ever want them to be. And certainly, if you take government money, there generally is the idea that there will be strings attached. I know if you were to start taking money for your church programs or something, government-funded grants for your church programs, it's almost certainly there's going to be some sort of strings attached. But in this one case, or in really pretty much everything we're talking about today, based upon the way the laws are currently written, there's not any of those strings like, oh, if we take this money, they can change our doctrine. Okay, I know that again, that may be a valid concern moving in the future. The very next law that comes out, that might be a valid concern. But the way every one of these current laws that we're explaining to you is written, there are no strings of that nature. You just follow these rules that are written out, and you're going to get the benefits. So I don't know if that helps you, in your decision-making process or not. But personally, if my church was struggling, I don't really know that I would have a moral reason to not take the PPL, and I'm just grateful that at the moment our church is not struggling, and I don't even have to think about the decision. But I wanted to just mention that to you. All right, next, we're going to change topics just a little bit and talk about the refundable employee retention credit. So, this is a pretty cool deal. It's where the government, again, wants to help you keep your employees on the payroll. But it's just a different way at coming about it instead of the PPPL. This is going to be a payroll tax credit for qualifying wages paid. During 2020, it's a 50% credit, and during the first 2 quarters of 2021, it's a 70% credit. So, the government's going to pay, but reimburse you, if you will, 50% of your wages during 2020 or 70% of your wages during 2021 as long as you meet the criteria. So let's look at the criteria. Number 1, operations have been fully or partially suspended as a result of a government order limiting commerce, travel, or group meetings. And then there's an or, so we can get to the second part, the or, there in a minute. But I want to just stop right here and talk about the first part. I believe most, maybe not all, but something very close to all churches in America have at some point been partially, either fully or partially suspended as a result of a government order. So, and I know it varies by, not only what state you're in, but what part of the state you're in. And, here in our county, we're grateful. Really, it only lasted a few weeks, but I think there's other places where it's lasted months and other places where it may still be continuing. So, if your operations were fully or partially suspended, then that's the trigger, and you start qualifying for this refundable employee retention credit. And, again, the government's really just trying to keep your employees on the payroll. So the last thing they want is a bunch of layoffs and people not working and stuff. So that's when they came out with these credits. Okay. What if, though, there's a time period where you're no longer fully or partially suspended? Because if you're qualifying under that first criteria, the full or partially suspended, we're only going to get the credit during that time period. So, for example, our church, we were closed, I think it was 3 weeks last spring. So we would be eligible for the credit for the wages paid during those 3 weeks. Well, that's a relatively short time period, but the pandemic, has lasted a lot longer than that, and I know there's disruption in churches that's lasted a lot longer than that. So there's a second criteria you could qualify under, and that is that you've experienced a significant decline in gross receipts. And now we have to define significant decline in gross receipts. For 2020, it had to be a 50% reduction in quarterly receipts measured on a year-over-year basis. So here's what that meant. Let's take, for example, the third quarter of 2020. If your church's gross receipts were less than 50% in the third quarter of 2020 than what they were in the third quarter of 2019, then you qualified. Then that means the wages that you paid in the third quarter of 2020 are eligible for this employee retention credit. Okay, so it was, a 50% reduction the calendar quarter compared to the calendar quarter from the prior year. For 2021, they've changed the rules, and you only need a 20% reduction in quarterly receipts. And those can be measured on a year-over-year basis or compared to the previous quarter. So there's two different ways that you can look at it for 2021. So, qualifying for this credit is a lot easier in 2021 than it was qualifying for it in 2020. So let's just kind of use an example here. Let's say in the fourth quarter of 2020, our gross receipts were $30,000. And in the first quarter of 2021, our gross receipts are only $20,000. That's a 33% reduction. 33% reduction is greater than the 20%. So that church would be eligible for this refundable employee retention credit in the first quarter of 2021. So that's, if you qualify, you can apply for it, and you do that on your 941 quarterly payroll report, and the government will refund 70% of those wages. So that could be a sizable figure. Okay. If you have less than 100 full-time equivalent employees, the FTEs that we kind of talked about earlier, if you have less than 100, then all wages are eligible. If you're a larger church and you have more than 100 full-time equivalent employees, then you can only get this credit on your furloughed employees or those who have reduced hours. I suspect most of our churches are less than 100 employees, and so that means all the employee wages you're paying are eligible. However, there is one gotcha here, and that is that the ministerial wages and the ministerial housing allowance do not apply under this credit. Now, that's different than what we had under the Pppl. Ministerial wages would have applied under the Pppl. Ministerial housing allowance would have applied under the Pppl. Does apply, but ministerial wages. So when you pay your ministers and you're not holding out the taxes on their check, like we've talked about in our previous webinar today, and that minister housing allowance is not eligible for the refundable employee retention credit. So there's some good, there's some bad. Just got to pay attention to all the details. Continuing on, a few more bullet points here about the employee retention credit. You can utilize the Pppl and the employee retention credit during the same year, just not for the same wages. And this is a change. So under the first two laws, they said you cannot, if you got Pppl, they said you can't use employee retention credit. But when the new law came out in December, they said, no, we've changed our mind. You can use them in the same year. So, you could get a round 2 Pppl right now in 2021. And you could also use the employer retention credit in 2021, but, this is a pretty big but, you can't use them for the same wages. So, if you get a Pppl and you're going to pay your employees using the Pppl, well, you can't get a credit on those same wages. That would be double dipping the same dollars, and obviously we can't double dip. So, it's going to be a little tough on the timing there to utilize both of these, but it can be done to use a Pppl and an employer retention credit. All right. For 2020, the amount that you could claim a credit on was capped at $10,000 of wages per employee, and that included their health insurance cost. So if you had an employee who earned $15,000 during the period that you were shut down, you could only claim the credit on $10,000. So they put a cap on the amount of wages you could use in your computation of your credit. Interestingly enough, in 2021, they've changed that cap to not $10,000 total, but $10,000 per quarter. So I think that's a pretty significant change. Back in 2020, if you were shut down for 6 months, you probably blew way past the $10,000, wage limit per employee. But in 2021, that $10,000 per quarter, I think, is a lot more generous. This credit offsets the 6.2 matching portion of your Form 941 payroll taxes. Well, I could go over that, and it's kind of complicated. Let me just kind of give you the short and sweet version. If you have eligible wages, you're going to claim a credit on your Form 941, and it's either going to reduce the amount you owe on your Form 941, or you're going to get money back on your 941. So, I don't think you need to dig into the details too much on it offsets the 6.2 matching. It is subtracted from your 941. And when you start to fill out your 941, you will see that, and you may have to get help because the 941 has gotten more complicated now that they've added these credits on there. But what if you say, well, that's great. They're going to give me a credit on the back end on my quarterly 941, but we could use the money now. Is there any way to get a little assistance now? I mean, they've got us shut down now, or we're partially shut down, or our gross receipts are down now. Can we get the money back any quicker? And the answer is yes. There's this Form 7200 that we did mention previously, and it's a form to file for a quick refund of these credits. So we could encourage you to use that if you want to get your money back even sooner. The IRS is granted authority to waive applicable penalties for employers who do not deposit applicable payroll taxes in anticipation of receiving the credit. Okay, that's a mouthful. Here's what that means. So, as you know, if you pay these wages, you're eligible for a credit, and you're going to claim that credit on Form 941. So if you pay your normal payroll tax deposits like you always have all throughout the quarter, and you say, well, I'm going to get a refund on my 941, here's what you could do instead. You could say, I'm just not going to pay my payroll taxes in these first 3 months. I'm going to take the credit early by not depositing my payroll taxes. And that is permissible, and the IRS will not charge you penalties. Now, you got to make sure it's the right amount. I mean, if let's say you qualify for $1,000 credit and you underpay your payroll taxes by $2,000, okay, well, then you will have a penalty because you short paid your taxes. But if you're eligible for $1,000 worth of credit and you short pay your payroll taxes by $1,000, that's going to balance out, and you're not going to be subject to any penalties. Now, the credit began on March 12th, 2020, and will expire on June 30th, 2021. Just a few more, just an example here of how this would work. So we've got a church here with 2 employees. Susan's salary is $5,000 per month. Bob's salary is $4,000 per month. The first month credit would be a total of $9,000 because, Susan earns 5, Bob earns 4. That's a total of 9. Multiply that times 50%. We're eligible for a $4,500 tax credit. The second month, we also have another 9 because nobody's crossed the $10,000 limit yet. The second month, Susan earned 5, Bob earned 4. There's another 9 times 50%. We get another $4,500 credit. The third month, though, the calculation gets a little more complex because Susan had already reached her $10,000 limit by the end of the second month, because she's making $5,000 a quarter, so she's already hit the limit. Bob only has $2,000 left before he hits the $10,000 limit, so our credit for the third month is only going to be $2,000 times 50%, which will be $1,000 credit. But over the 3-month period, we got a total of $10,000 worth of credit. So again, nothing to sneeze at. This is a very viable tax credit if you qualify and meet the criteria. All right, I'm going to shift gears on you just a little bit. Talk about deferred payment of payroll taxes. And Kevin mentioned this when he went through the agenda. We're really not in favor of this, but I guess that's not our place to say. It's our duty to provide you with the information, let you make your own decisions. So I'm going to just share with you what it says. The 6.2% Social Security matching payroll tax for 2020, you didn't have to pay it in. You could defer it, and you would have to pay 1/2 at the end of 2021, and you would pay the other half at the end of 2022. So it's basically the government saying, we'll kind of float you a loan, if you will, because you're not going to have to pay in all your payroll taxes. The reason we're against it, we're just not big fans of not paying your payroll taxes when you owe them, because we've just seen too many situations where, we've had clients who say, well, I'm not going to pay my payroll taxes now, but I promise I'll have the money next month and I'll pay them then. And then next month gets here and they don't have the money then either, and now they're in big trouble. So we don't want you getting in trouble with the IRS, having taxes due that you can't pay. If you're struggling now, how do we know you're not going to be struggling at the end of 2021 or 2022? So, just prudence and wisdom. We prefer to pay our bills as we go. And so, we're kind of opposed to this. But it's out there. It's legal. And if you were super confident that you would have the money, then I guess it gives you a little cash flow float for a period of time. Now, this only applied to the payrolls between March 27th and December 31st, 2020. And when you pay those deferred payroll taxes at the end of this year, 2021, and the end of next year, 2022, you wouldn't know any penalty or interest on it. So, basically it's a tax-free, interest-free, penalty-free loan from the government. But there's our big caution. Be sure you pay the payroll taxes by the required date. All right, next slide, talking about relaxed rules for charitable contributions. This doesn't directly affect the church a ton. It more so affects the members of the church, but it was relevant to churches, so we thought we would include it. There's now an above-the-line deduction for charitable contributions. So previously, charitable contributions, you could only deduct them if you were claiming itemized deductions. And because of the Tax Act of 2017, many Americans are no longer claiming itemized deductions. They're just claiming the standard deduction because the standard deduction was increased so much. Not many people are itemizing anymore. Well, for 2020, the government wanted to encourage charitable giving, thinking it would help our communities, and I believe it would and could and should. So they said, we will let you claim up to $300 of cash contributions even if you don't itemize your deductions. And then for 2021, for married taxpayers, that is $600. So for 2021, you can claim a $600 above the line deduction for cash contributions even if you're not itemizing. So in theory, that should have encouraged Americans to be more charitable, and I hope we see that that's the case. Here's another rule about charitable contributions. For a couple of years now, we've had a 60% limit on deducting your charitable contributions. What that means, that 60% is compared to your income. So if your income for the year is $100,000, you could only claim $60,000 of charitable contributions. Even if you'd given 70, the extra 10,000 would have just carried over to the next year. Well, again, the government's trying to encourage us to be charitable. So for 2020, they removed that 60% limit, and folks can now deduct for 2020 up to 100% of their income can be deducted if they made that much in charitable contributions. All right, just a quick slide here just to talk about online giving. As Kevin mentioned to you in the beginning, Kevin and I own a software company, and one of the things we've noticed in our software company is that, some churches in the past were not using online giving, but now because of the pandemic, we think it's relatively essential. I know at my particular church, we've struggled to have, we were closed for a while, then pastor was sick for a while, and we just had, different things going on. And so it's been a challenge, but one thing I will say, online giving has been consistent. So it's really, I think, been helped our church, and we're glad we've got it. So there's just a slide with some statistics and information about online giving. If you're not yet doing it for your church, you probably want to look into that. And one way you can look into that, and we're basically wrapping up the webinar here. We'll get to your questions and answers in just a second. But one way you can transition to online giving, if you haven't done it already, is using our software. We have cloud-based software, and with our Plus version and above, you can get online giving. We have desktop software, which does a great job of tracking members' contributions and accounting, but the desktop doesn't offer the online giving. So, if you want to integrate your online giving with us, you'll need to go to the cloud version, which is what I use at my church. Makes my weekly, I'm the volunteer treasurer at my church, and so my weekly duties move pretty quickly because of the software. I think is well designed. All right, well, let's move on to your questions here and see if we can review those and see if we have any questions to answer. Any questions, Kevin? Okay. Well, I think I'm going to wrap this up, and we'll answer any questions in the comment section. We'll reply there. So I hope you've enjoyed this webinar today. And if you got into the middle and you want to see the rest of it, you can always look at our website, which will have a link to our YouTube channel, and our FlockBase Facebook page will also have a link to our YouTube channel. So blessings to you. I hope you have a great weekend, and let us know if we can help you. Thank you.